Welcome to the third part of Chapter 2. In this section, we will learn how to record transactions using the accounting equation, accounts and debits and credits. We call this recording process journalizing. We will also learn how to transfer the journal entries we record into the general ledger. We call this process posting. You have just learned two new terms used to describe the process of accounting for transactions: journalizing and posting. You will find this information starting on page 61 of your textbook. In the last section of Chapter 2, we discussed how to apply proper double entry accounting to assets and liabilities by analyzing transactions using proper source documents and applying debits and credits, also known as double entry accounting. In Step 3, we recorded general journal entry. At the end of the accounting period in Step 4, we post the information from the general journal to the proper general ledger account. We need to do Step 4 because the general ledger groups all transactions that impact a particular account. That is, all the transactions that increase or decrease the cash account are posted to the cash general ledger account. It is only by posting transactions from the journal to the general ledger that we can summarize each account's balance, summarize all the account balances in the trial balance, and prepare financial statements for our users. So let's review what a journal and a journal entry are. The general journal is a complete record in date order of each transaction of a business. Journal entries are entries recorded in the general journal using debits and credits to describe what happened in a transaction. They are how transactions are first recorded in the accounting system. Journal entries are transferred or posted to one entry at a time as debits and credits to each account in the general ledger. Each journal entry represents a single transaction. Every journal entry has at least one account that is debited and at least one account that is credited. Each debit and credit is of equal amounts. And finally, the general journal holds all the journal entries. No matter how much experience we have, we always ask a set of 4 questions prior to recording a journal. In a few weeks, this will become a subconscious process for you, but for now, it will be helpful to you to think through each of these steps. First, what accounts are affected? Cash, accounts payable, etc. For each account affected, what type of account is it? Is it an asset, a liability, equity, revenue, expense, etc.? For that account, does the account balance increase or decrease? And finally, to reflect the increase or decrease, do you debit or credit the account in the journal entry? For example, an increase to cash is recorded with a debit. Okay, let's move on to actually recording journal entries. Here is an example of the proper recording of a general journal transaction. We have seen a similar transaction before. In this case, the owner of the business invests $30,000 cash in exchange for common stock to start the business. In other words, cash increases and common stock increases. You'll notice a journal entry has 4 parts. First, the transaction occurred on December 1st, 2015. The date is important when recording general journal transaction and is recorded on the left side of the journal in the date column. Secondly, we identify the accounts affected by the transactions. Debits are always listed first in the journal, followed by credited accounts that will be slightly indented to the right below the debited accounts. This is important for those of us, like me, that have to read through a list of journal entries. It helps us differentiate what accounts are debited and what are credited. Here, the cash account is an asset account that has increased. We show increases in assets with a debit to that account. The common stock account is also increased, and we show increases in equity accounts with a credit. The dollar amount is placed in the appropriate debit or credit column. In this case, the cash account was debited for $30,000, so we place that amount in the debit column. Common stock is credited for $30,000, so we place that amount in the credit column. Finally, we prepare a brief description of the transaction so other people, like me, who view our work will understand the nature of the transaction. This explanation is dented about as far as the credit account titles to avoid confusing it with accounts, and it can be italicized. Again, another important feature for those of us who need to review journal entries recorded by other people. After transactions are journalized, they are posted or transferred to the general ledger as soon as possible. Computer systems are often set up to permit posting to general ledger accounts immediately, but smaller systems and manual systems might be updated once a day, weekly, or, God forbid, when time permits. We will review a four-step process that is important to post journals for each debit or credit in a few minutes, but the next point is important, okay? You are required to post journals to the ledger for the accounting cycle in Chapter 2 and Chapter 3. Please review these slides in your text to ensure you understand the process. Before we review how to post journals to the general ledger, let's talk a little bit about formatting. We learned T accounts are useful illustrations, but balance column general accounts are used in practice to post journal entries and to come up with a running balance in each account. In fact, the balance column general ledger account that you see on the screen is very similar to the format that would show up in most computer systems that I've seen. The balance column account is similar to a T account in having columns for debits and for credits. It is different from a T account in including transaction date and explanation columns. It also has a column with a balance of the account after each entry is recorded. This is an important feature because it allows us to check the balance in the account as transactions are posted rather than waiting until the end of the month. Let's consider the cash account. We recorded a journal entry to in the prior example. In the upper right-hand corner of the ledger account, we assign an account number to the cash account. In computer processing of information, numbers are far more efficient to use than alpha characters. When we speak of an account number 101, we are referring to the cash account. We have a debit or an increase column and a credit or a decrease column and a running balance. In fact, it looks similar to your checkbook in the sense that you can see both cash receipts and payments and a balance. Now, posting is simply the process of transferring the information from the general journal to the general ledger. As a reminder, we must post transactions to the ledger in order to prepare a trial balance and financial statements. A word of caution, though, before we get started. It is very important that you post one journal entry completely before you move on to post the next journal entry. Also, you should post in order from the first debit in the journal entry to the last credit in the journal entry. An example of what not to do is to search through all the journals and post all the entries to cash first before going to another account. The failure to post one entry at a time increases the chances that you will have a posting error and forget to post part of a journal entry. That causes big problems later for you because your general ledger will then be out of balance and you will have to look for what you missed. There are 4 steps in the posting process. First, start with the first entry in the journal. Identify the first debit account in the journal entry. Find the same account in the ledger. Transfer the journal date December 1st to the ledger. Place the debit amount of $30,000 in the debit column in the ledger. Entering the explanation is optional because we can go back to the general journal to see the explanation. In our textbook, the explanation column is reserved for adjusting journal entries made at period end. We will discuss adjusting entries in Chapter 3. Next, indicate where you can find the general journal entry. In this case, it is the first page of the general journal. We use the letter G to mean general journal. Finally, update the running balance in the cash account. Enter the debit number from the ledger in the PR, that's the posting reference, column of the journal. This tells you that you've posted that journal line item. Now you can go back and forth between the general journal and the general ledger. This is known as a cross-reference and leaves a clear trail. So this is what we do in step 2. In computerized systems, the account number normally is automatically associated with the account name via the chart of accounts, so you don't have to do this. Step 3. Identify the credit account in the ledger. In this case, it is the common stock account. Enter the journal date, the journal page, the amount, and the balance in the ledger. And in step 4, enter the credit account from the ledger to the posting reference, the PR column of the journal. Now let's begin using the double entry accounting system to put it all together. Let's see if we can analyze transactions and get them into proper form for double entry accounting. This will be helpful when you turn to your homework. Recall from Chapter 1 that we analyzed transactions using the accounting equation before recording them in a journal. So we will follow these 4 steps in double entry accounting. First, identify the transaction and any source documents. Second, analyze the transaction using the accounting equation. Third, record the transaction in journal entry form, applying the double entry accounting. And 4, post the entry to the general ledger. Now your textbook provides a full illustration using Fast Forward Company, starting with the transaction on the next slide. So let's review what happened. In the first transaction, the owner invests $30,000 to start a company called Fast Forward. From our previous work, we know the cash account and the common stock account will increase. We record this information in the general journal with a debit or an increase to cash and with a credit or an increase to common stock. Notice that the account number for the cash account is 101 and for the common stock account is 307. We are going to post the information in the journal to the general ledger. In this illustration, we are using T accounts to depict the general ledger rather than the column balance format. Believe me, T accounts are easier to use when we don't have the general ledger forms available. We use them all the time in business. You will find our textbook hopping back and forth between the two, however. We place the $30,000 on the left or the debit side of the cash account and on the right or the credit side of the common stock account. Our books are in balance because total assets are equal to total liabilities plus equity. We could continue on with more transactions, but the process is the same for every transaction. Your homework will help reinforce what we've done here. Please be certain to review the illustration provided in your textbook for Fast Forward Company. The final step in the double entry accounting process is to prepare a trial balance. We'll take a look at the trial balance of Fast Forward at the end of December in part 4 of our presentations. Okay, that's it for now. That was a long video. See you in our upcoming discussion about financial statements. Good job. Hang in there. Just one section to go.